the legal aspect of the pension benefit, I think, is the most critical thing to whether or not you all get to experience a pension benefit throughout the duration of your retirement. But I did want to spend just a few minutes talking about what we do with the assets that come into the fund. So Mary Pat's comments were related to a lot about the legal protections of your benefit. I'm going to tell you a little bit about once the cash gets into the pension fund, how we invest it, and how we think about investing a portfolio of assets when we have $6 billion in liabilities and only about $1 billion in assets. So my name is Brady. I work for a company called Callan. We advise pension plan sponsors, both public pension plans and corporate plans. So we work exclusively with institutions that don't pay taxes. So when we invest the assets that are put into the pension plan, we do not have to pay taxes on the investment gains. So that's an important differentiator from your own personal portfolios if you buy stocks or bonds. So stepping back and looking at how pension plans work, the assets that active firefighters put in are contributions. Typically, employers, and in this case, the city puts in investments, and that's the pool of assets that we have to invest in getting investment returns. So that's the C and the I. Those are the assets that are available to pay benefits to you, and then the expenses that are required to administer the fund. If we look across the United States, of all the pension benefits that have been paid between 1989 and 2018, where do those assets come from? The vast bulk of the assets that have been used to pay pension benefits in the United States come from investment earnings. So for the majority of pension plans out there, the investment portfolio is of critical importance. So that's that blue piece of this pie chart, $5.1 trillion. So when we add up all the pension plans across the country, there's about, $7 trillion. 26% of that has come from employers, the city, the state, other sponsoring entities putting in money. 11% has come from active participants contributing. But the biggest chunk, the majority, has come from investment earnings that have been made once those assets are in the fund. The critical challenge that we face here at the Fireman's Annuity and Benefit Fund is you need to have those contributions. You need to have the green and the orange slice of the pie before you can make the blue one. And we've been in a position where we have not had the full contribution from the employer over time, so it's limited our ability to make that blue slice of the pie. Mary Pat had some numbers that were slightly different, and let me just explain what we're showing here. So there are, Mary Pat talked about things called actuaries, so there's somebody out there that the fund hires to estimate the benefit that is owed to every single participant and their beneficiaries. They add up that number every year. That number grows because the firefighters and paramedics accrue additional benefits. And also, people are living longer these days, so that liability grows every year from benefits that have been gained, but also because people are living longer and they will be paid their benefit for a longer period of time. So, according to Gabriel Roeder Smith, the fund's actuary, at the end of 2018, they estimated that we owe $6.2 billion in liabilities over the life of the pension plan. There's a market value of assets on hand of just over $1 billion. So the difference between those two is what Mary Pat called that unfunded liability. So we've got a little less than 20 cents on the dollar. And where that becomes a big problem is, in order for this investment portfolio, the green bar, to try to keep up with the orange bar, it has to grow at least 5 times as much as that liability. And that's virtually impossible to do without taking inordinate risk or being imprudent. And one of the things I did not mention earlier when I described Callan, so I work for the board of trustees. I work with your chief investment officer, who's a member of the pension fund staff, and we advise the board on a non-discretionary basis, meaning we don't move money unless they tell us to do. We make investment recommendations to them, and then it's ultimately up to them to vote. And the board, as you know, consists of a lot of different people with perhaps different interests. But when we're sitting around the pension table, they are fiduciaries to you, as am I, meaning we have to make decisions with your best interest in mind. And at some point in the history of this fund, when you have $1 billion and you need to make $6 billion, the investment is not a solution to this problem. So the trustees were faced with this issue. Okay, the city over many, many decades, and I think we heard yesterday, Steve, that maybe since 1931 the fund has been less than 100% funded. So this has been a challenge this fund has faced for many decades. The board has to decide, do we want to take on more investment risk to try to solve this challenge that we've had of the city not putting money in? So there's been a point where we said, you know what, we're not going to take any more investment risk. Where we are now and what we've done over the past 10 years, I think has been about as good as you can get. So this chart is very complicated. I'll focus on what we show on the right-hand side of the page. And this is the 10-year return of the pension plan ending June 30th, 2019. And the fund during that period has returned almost 10.5% on an annualized basis, so on an average basis over 10 years. And again, this is since the bottom really of the global financial crisis. So 10 years ending 2019, this excludes 2008 and the first part of 2009, which were very difficult returns. But the fund has earned a return that's beat its benchmark, so we measure ourselves against a measuring stick that says, hey, if we invested all in index funds, what would we have earned? This fund uses active management to try to exceed benchmarks and try to get as much incremental return as we can. Over this 10-year time horizon, we were successful in doing it. We returned 10.65%. And these gray bar charts just show the range of returns that other public pension plans of a similar size earned during the same time horizon. So that 10.65%, that was the 6th percentile. And in the investment world, we do things differently than in education and elsewhere, healthcare. The lower the number, the better. So the 6th percentile rank means this fund's return beat 94% of the other public pension plans out there. That was an extraordinarily positive return and a good benefit. But as you saw earlier, the funded status is still only 16.8%. So even though we had a decade of great returns, because our asset pool is so small relative to the liabilities, it really wasn't effective in closing that gap. How is the portfolio invested? So we do have just shy of $1 billion. About 900 of that is on hand, invested in a diversified portfolio of stocks and bonds. The remainder is, I think, with the city, or is a mechanism like a credit that the actuary recognizes that the city owes into the fund. But this is the target asset allocation that the pension board has adopted. This bottom blue slice is the most the most conservative part of the portfolio. That's fixed income. About 60% in publicly traded stocks. So this is a portfolio that's fairly aggressively invested. As I look out, if you had your own portfolio, you probably wouldn't put 80% in risky assets and 20% bonds. As individuals, if you had to do this on your own, it might be the opposite. You might say, I want to put 80% in bonds and 20% in equities because I don't want to lose a whole lot of money. But because the fund, as we heard, is a perpetual entity, will be getting contributions into the future, we can invest your aggregate assets in a way that's very different than how you would all invest on an individual basis. So we've positioned the portfolio at 20% fixed income and 80% other investments to try to generate additional returns. So just because investment returns won't be the one thing that can solve that $5 billion unfunded liability, it doesn't mean we and the board are not going to do everything we can to try to manage the investment portfolio to add incremental dollars into the fund. So we're trying to generate strong returns. Over the past several years, we've embarked on a process of improving diversification. So a lot of those little pie slices on the side that have small allocations have been added over recent years to try to smooth out the pattern of performance over time. I mentioned earlier that the portfolio returned over 10% on an annual basis, and that's an average number, and if you know, averages can be a little bit deceiving, so just to put that number into perspective, in 2018, just looking at a single year return, the fund was actually down 6.2%. But in 2017, the fund was up 18.3%. So the way the actuarial smoothing works and these averages work is we know that with a portfolio like that, you're never going to hit your target of 7.5% or 7% every single year. We're going to be below it, we're going to be above it. But on average over time, we've been successful in generating a strong investment return. So this is how the portfolio is split up to different types of investments. Each one of these pie slices has an investment manager that we help your board of trustees select. That manager then takes the money of the fund and buys a diversified portfolio of stocks, bonds, or other type of investments. And then on a monthly and a quarterly basis, we present reports to your board of trustees to tell them how this fund is doing, how each individual manager is doing. Now these assets that are in the fund, they're held in trust by a bank, Northern Trust in Chicago. They're the custodian of the fund's assets. And once they're put in the trust, they can be used to pay your benefits. There's no way the city can take those back. When we made this recommendation to the board to adopt this strategy, there were several key assumptions. You've heard this a little bit before, but it bears repeating. The expected contributions that Mary Pat discussed were a critical assumption in adopting a somewhat aggressive asset allocation strategy. If there's a change to the Constitution or a change to that ramp to the arc or the other things that Mary Pat mentioned, we may have to revisit how this is invested. Because the future health of the plan is highly dependent on the city sticking to that plan. Let me just try to illustrate some things, and in retrospect, this is a terrible way to illustrate this, but this is the issue Mary Pat talked about, the ramp. So if you look at the blue bar, it's kind of hard to see. That represents statutory contributions. So this is information from the actuary. This is another way of illustrating the contributions the city has to make. They're fairly modest, or they're low, but going up right now. So about $250 million over the next couple of years, but then you can see it jumps up. And the great thing about that plan, if the city sticks to that plan, is we need to pay that yellow bar every single year. That is the benefit that pays retirees and their beneficiaries every single year. So we've been in a position where, when we look at the money that you put in, or had put in over time, the money the city put in, that wasn't enough to pay benefits on an annual basis. So we were in a cash flow negative situation. Mary Pat mentioned you would never run a household like that. Sometimes it happens, but it's very difficult to pay out more than you're making. So with this new legislation, that ramp to the arc, we do turn from a slight cash flow negative situation to one where we have an incremental positive cash inflow. And over time, over decades, that positive cash flow will be put into the investment portfolio. And if we're successful in earning returns, as we think on average over the 10 or 20 or 30 years, we will chip away at that unfunded liability with the plan for the legislation to get us to 90% funded by 2055. So just a couple quick takeaways from my presentation. The path of getting this plan to sound funding is through those employer contributions coming in. There are some plans that we work with. Mary Pat mentioned some that are in a better financial situation because they get contributions. They might be in a situation where they can change how they invest the portfolio to get it to fully funded. But here we're really reliant upon the city to make their contributions as they've agreed to based on the current legislation. Investments have been strong. You saw the funded status deteriorate over time. That's not because the investment portfolio has not performed as we expected. It did perform well. It's just because we're facing such an uphill battle, there's no way you can invest that portfolio to solve it by itself. We really need time, and we also need the employer to kick in those contributions. One last point came into play in 2017 when we made the recommendation to the board to adopt that asset allocation strategy that you saw on the pie chart. The cash flow situation is common for other public pension plans. A lot of pension plans are mature, they're paying out benefits, they're not getting as much in from active employees or from plan sponsors. So it is common for public pension plans to pay out more than they're taking in. And for the investment portfolio, sometimes that means you can't invest in certain types of investments that you can't buy and sell on the stock market. Less liquid, real estate, or private equity. These are things that can provide the fund a higher rate of return over time. So when we looked at the fund's liabilities, we studied how we might allocate their assets, and we did determine that that cash flow situation, despite the low funded status, but because those contributions were expected to come in, that you were still able to make these modest investments in less liquid assets that will give us a higher rate of return over time. So that's really it from an investment standpoint. Just to reiterate, the portfolio is well diversified. It's monitored on a regular basis. The trustees here can tell you the boring reports that I give them on a regular basis. It's monitored by an outside advisor, me at Callan, my firm, but also by your chief investment officer and the rest of the staff at the Fireman's Annuity Benefit Fund. And again, the future success, the ability to close that $5 billion gap, is really contingent upon the city sticking to the plan and time for that plan to kick in. So with that, I'll wrap it up. Maybe see if there are any other questions about investments. If not, I know it's kickoff in maybe 15 minutes. So, oh, yes, sir.
What is it costing the fund, percentage-wise, to manage our money?
Yeah. So the question was, what does it cost the fund, percentage-wise, to manage the fund? So I think the investment costs all in are about 0.4%. So 40 basis points about. Those are the fees you pay to the investment managers that are hired by the fund. So the returns I showed you, those are gross of those fees. So the net return, instead of 10.65, is probably something more like 10.25. Any other questions? Maybe just one other quick comment on cost, because it is something that's a critical fiduciary duty. So the board monitors the costs that are paid to hire investment managers, and when we do so, we engage in active negotiation to make sure that the fee that they want to charge us is the lowest possible fee that we can get. In the last several times we've hired new investment managers, we've been successful in getting them to go lower in terms of the fee that they would charge us to manage money on behalf of the fund. So we're doing our best to keep an eye on that number. Yes, sir.
The question about this. The purple is the employee contribution, right?
That's right.
And the yellow is the employer contribution.
Yeah, so I'll start from left to right. The question is just to explain these with the bar chart again. On the far left, the blue is the statutory contribution. That's what the city is putting in. The next one is the employee contribution. So think of those as the two cash flows going in. That's your money. Benefit, the yellow bar, that's the money that's going out. And then the fourth bar there, net cash flow, that's the difference between the first two and the third.
So you have to add up the brown one and the purple one.
That's correct. Yeah, the brown and the blue would be the net contributions of both employee and employer. That's the cash flow coming in.
So that's the expected with the current goals.
That's right. Yep. So the actuary projects how much employees the fire department will have, how much they'll put in, and and it uses this legislation to estimate what the contribution will be. So they make a lot of assumptions. Yeah.
Following that, if there's an expected, let's assume, go with that premise, is an expected surplus, right?
Yeah.
That adds to that investment amount of management. Basically, if the fund isn't going negative for 36 years, $1 billion performing at some interest rate, 6, 7,
Yeah.
whatever, will add up.
That's right. So the question is about how do we chip away at that $5 billion unfunded liability, and it's the last bar chart here. It's a small, greenish, positive number. But eventually those contributions coming in are greater than what's being paid out by a very small amount. That goes into the fund. We invest that. And the plan is to grow slowly over time so that at some point that $1 billion chunk of money that we have grows to meet that $6 billion of liability. But it's going to take...
So how to put that together in my question is, the actuarial analysis, does that take into account an expected return?
Yes.
What is that expected return?
The expected return is 6.75%. So it's reasonable. We think it's very reasonable. Yes, sir.
Can active and retired firefighters make an impact on our funding by taking action? For instance, active paying 11 1/8 rather than 9 1/8, for instance, or active retired capping their benefits at, let's say, $100,000 a year, and nobody takes a higher amount than that per annum. Are there things like that that make a substantial effect on this or not?
Yeah, so the question was, what can be done from a benefit perspective, I think, to change this picture? So my focus is really on how do we make that asset pool bigger, but another way to fix that $5 billion gap is to change the benefits. You could, that's above my pay grade, I think, but there are ways, I'm going to let Steve answer that maybe.
Sir, well, I mean, larger member contributions, I mean, certainly would add to the fund, but then again, that would change legally what people, you know, the contributions, and that was part of the Jones case that was mentioned earlier, because that was brought up in that case where the city tried to raise contributions for active members. The members sued Jones and Johnson, and that was overturned. So those things have been tried. It's difficult, and really active member contributions, if you look, compared to the city contributions, are quite small. So even if you increase those a little bit, you're still not going to really change it the way it needs to be done in terms of the larger city contributions.
All right. Any other questions?
Brady, thank you very much. Brady. I think we're all confident that it's everything we have. So, we're going to get all this information out on our website, all the presentations, and also video. So, thank you. Have a good day.